ari ukwishura.
We are looking at a dividend as our next part to discuss. Dividend, and we are saying dividend is a distribution to the shareholders. So, what are the types of dividends?
Yamuremye uri kudusakuriza.
Types of dividends? When it comes to types of dividend, we ought to have the cash dividend.
Excuse me, Mr. Mayor.
Yes, please.
I request you mute all of us because some people, I think they don't know how to use these devices. So we are totally disturbed.
So I mute.
Yeah, all of us.
Yamuremye.
I'm not seeing the.
Mute Felicien Yamuremye.
Yamuremye, please.
I'm not, you know, I'm in a whiteboard. I'm not seeing the other parts. Oh, it is here.
You are disturbing the class.
Okay, I'm muting everyone. We are looking at the types of dividend, and the first dividend we are talking about is the cash dividend. So under this, the shareholders are given cash. The shareholders are given cash as part of their dividends. In a cash dividend, the shareholders are given cash as part of their dividends. So that is the cash dividends. Then the second one we can talk about is what's called the stock dividend. Under this, the shareholders are given shares as part of their dividends. In a stock dividend, the shareholders are given shares as part of their dividend. It is commonly practiced. It is commonly practiced when shareholder or when the company is facing cash flow problems or when it has investment opportunities. So instead of giving shareholders cash, then you give them shares as part of their dividends. And this is mainly done when the company is having cash flow problems or when the company has got investment opportunities but does not have enough money. It's almost the similar to what we have talked about. The company has got investment opportunities, but it has no cash flow, so it doesn't have enough money to invest. So instead of giving the money to the shareholders in cash, then you give them shares as part of the dividends. So that is the cash the types of dividends. Can we move on?
Yeah.
Yes,
I
sir.
need to ask a smaller question, please.
Yes.
Under stock dividends, when shareholders are given shares as part of their dividends, are these new shares to the addition of existing?
Yeah, the company will issue new shares.
So their share ratio will increase.
Yeah, their share will increase. The number of shares will increase.
Okay, thank you.
Okay. Types of dividend policy. We have what we call a residual policy. A residual policy. A residual policy. So under this policy, the shareholders are only given a dividend when the company makes profits and it has no investment opportunities. If you look at the residual policy, the company will give a dividend to the shareholders only when the company has made a profit, or the company may even make a profit and it has investment opportunities. Then in that case, the company may not give a dividend. So that is the residual policy. Then you have the constant policy, or sometimes we call it a constant payout ratio. Constant payout ratio. A constant payout.
That is number 2.
That's number 2. So under this policy, the entity calculates a constant percentage on the company's profit as a dividend. In a constant payout, or sometimes we call it a constant policy, the company will calculate a constant percentage from the company's profit as a dividend. Meaning, if the profit increases, the dividend will increase. If the profit reduces, dividend reduces. If there is no profit, the company may not give dividend to the shareholders. So that is the constant payout ratio. Then number
So,
three.
sorry,
Excuse me.
question.
Yes.
At this constant policy, meaning that it will be at like a rate at when you say a percentage, and again you say a constant amount. It's a constant, it's amount, a figure, or it's a percentage which is given.
Percentage, a constant percentage. That's what I used. A constant percentage. If you say we calculate 20%, is it okay? It can be 20%. Say if the profit is 20, if we earn profit, 20% is given as a dividend. That's going to be, it means the dividend payout ratio will be 20%.
It seems the number 2 is part of the number 1 because all of them are based on the fact that there is profit gained.
Yes, but in number 1, a company may even give profit and it does not give dividend.
Sorry?
In number
Come
1,
again, please.
in number 1, the company may even get a profit. The company may get a profit and it does not even give a dividend. It's going to depend whether it has investment opportunities or there is no investment opportunities. But in number 2, automatically, the company will have to calculate a dividend on the profit as long as there is a profit.
Okay.
Yeah. Then you have a stable policy. So under this policy, the company pays a constant amount per share as dividend. What is the difference between number 2 and number 3? In this part, in a stable policy, you have a constant amount. Maybe you may say that I will be giving a dividend of 10 per share. It's going to not to depend on, it won't depend on the profit. Whether there is a profit or not, you will pay that dividend of 10 per share. But in a constant, the calculation depends on the profit. That is the main difference between these two.
That one might be illegal because legally a company should issue the dividend to the shareholders when there is a profit from the profit.
Now, that is true. But the problem in a dividend is that if today you give a dividend and tomorrow you don't give, you are communicating an information that is not correct. That is going to affect the shareholders. What company do is to provide a certain amount as a dividend. Because if today you give, for example, suppose you are a shareholder, today you are given 100, tomorrow you are given 10, another day you are not given. what are you going to think about the organization?
One to think that the organization is not making profit stably.
Yeah, so you may need to reinvest or to invest your money into another company. So in order to avoid
Yes.
those speculations, what companies do is to give a certain constant amount as a dividend. Say we shall be giving 20 per share as dividend. So you cannot know when things are good and when things are bad. Because at the end
It
of the
means
year,
that
you are going to get your amount as the shareholder.
it means that even if the business on the party two fail, don't get a profit, they must pay a dividend. It means that the company must align himself for
Yes.
paying that dividend as cost.
Yes, it will pay dividend.
Oh, thank you.
I think this stable policy is the same as
Then number
dividend
4,
share.
we have what called a compromise.
Before you go to number 4, you better to add that statement on number 3,
Yeah.
whether whether or not the company made a profit.
As long as
it will make it be very clear.
As long as it is a constant amount paid per share,
Sorry?
automatically it is clear that even if you have made a profit or not, the company will have to pay dividend because you are paying a constant amount. If you don't have money that year, then you can decide to give shareholders maybe shares instead of cash. Compromise policy. This combines the constant payout and the stable policy. So this means that the company pays a constant amount per share, and then a certain percentage on the retained earnings as dividend. This is done to help the shareholders in the case a company has made enough profit. Because if you look at the disadvantage, the disadvantage of a stable policy is that when the company makes huge profit, for you, your dividend does not increase. So what some companies do is to combine the two policies. They combine a constant policy and a stable policy. So shareholders are given a constant amount, but on top of that, if the company has made good profit, then they can be given a certain percentage on the retained earnings of the company. So those are the...
Excuse me, sir.
Yes, please.
I need more explanation on constant payout ratio, then stable policy. And the number 2 is what are the factors affecting this dividend policy? Thank you.
So as we have said, in a constant payout, you calculate a percentage on your profit and distribute it as a dividend. A percentage on profit is distributed as a dividend. That is the constant payout. For example, you may say 40% of our profit should be given to shareholder. So it means your payout ratio would be 40%, given 60% retained. That is the constant payout. Now, when it comes to a stable policy, you have a constant amount per share. You are not calculating based on the profit, but you have a constant amount per share given as dividend. So it may say on each share, we are going to give a dividend of 20. That is going to be a stable. Whether the profit is high or the profit is low or no profit, you are giving a dividend of 20 per share. That is the stable policy. Now, what factors that may determine this payout? That is what we are going to discuss. The factors which determine or which affect or which influences a dividend policy. Can we move on? That's what we are going to discuss. I'm forgetting the name. That's what we are going to discuss now.
Okay, thank you.
Excuse me, lecturer.
Yes.
For number 4, is it appropriate when the company want to reduce on the accumulated earnings?
No, in number 4, what we do is to help the shareholders, because sometimes the company may make a huge profit, but in a stable policy, whether the company has made a huge profit or not, for you, your income is not going to increase. It is like a way to help the shareholders to get some more money from their investment.
Okay.
Let's look at the factors which affecting the dividend policy. Which factors affect a dividend policy? Number 1, we can say the company's growth. Company's growth. Please, when you see my explanations, I'm not writing too much. I'm writing a point and then 2 lines to explain. That should be your policy. Don't too much. Write a point, then 2 lines or 3 to explain your point. But you find people want to die on a point. Write, you open a page, explaining 1 point or hiding your point. So the way I'm writing, it should be the way you should write. So if this is my paper, I've mentioned my point, company's growth. So when the company is growing, that's what I can say. When the company is growing, it needs more funds. It needs more funds to finance its growth. When the company is growing, it needs more funds to finance its growth. Therefore, this will affect the dividend policy. to use. So in this case, you find that the company may go for a constant payout, a company may go for a residual policy, or the company may have a stable policy because you need the money to finance your growth. Then I can put number 2, stability of earning. Stability of earnings. Stability of earnings. If the company's earnings are stable, then the company should pay a dividend. If the company's earnings are stable, you have a stable earnings, then it is important you pay a dividend. Either you can use a stable policy or you can use a constant payout. But you should pay a dividend to the shareholders if the earnings are stable. But if the earnings are not stable, the company should either adopt a residual policy or a constant payout. A constant payout ratio. Number 3, liquidity.
Sorry.
Yes.
Sorry.
Yes, please.
I want to know exactly the meaning of earning. Earning is like profit or
yes.
no?
Profit. Or even your sales. If the company is facing liquidity problem, if the company is facing a liquidity problem, then it may use the residual policy. And similarly, if the company is not facing liquidity problem, the company may adopt any other policy. Hope we are together there. We are looking at factors that are influencing or
Yes, we
affecting
do.
dividend policy. Number one, we are saying the company's growth. If the company is growing, you need the money to finance your growth. And therefore, that is going to affect your policy. Stability of earnings. If the earnings are stable, you can use any policy to pay your dividends. But if earnings are not stable, then you can end up maybe adapting a constant payout. You can adapt a residual policy because you are not sure of the earnings. And another point we have talked about here is the liquidity. The liquidity. If the company is facing a liquidity problem, then automatically you need the cash flow. You cannot give a dividend when you are facing a liquidity problem. You need the money in the organization. So in this case, you can go for a residual policy. Or you can go for a constant payout.
Question, sir.
Yes.
On point number one, company's growth, is the residual policy favorable to be adopted when the company is in such a situation?
You know, the issue is, if the company is growing, you need the money. Because you need the money, remember the residual policy says, you give dividend if you don't have investment opportunities. So you can now go for a residual policy. You only give dividend if you don't have investment opportunities. That is the residual policy. Now, please, as I'm writing, that's how you should write your question, which are theoretical. Mention a point, then few lines to explain. A point, few lines to explain. A point, few lines to explain. So number 4, we can talk of the level of leverage or level of gearing. The level of gearing. If the company is highly geared, if the company is highly geared, it needs money to pay a fixed interest cost. A fixed interest cost. Thus affecting the dividend policy to use. Thus affecting the dividend policy to use, because you need the money to be able to finance your activities. Can we go on? We go to another slide, or you are still writing?
Let's move on.
Yes?
We move on. These are simple worded things that we
I'm recording. I'm recording the video, but don't worry. So we stop from point number 5. We go to number 6.
We stopped on number four.
We stopped on number 4.
Number 4.
Okay,
Number 5.
Regulations. Government regulations. Government and capital market regulation. And capital market regulations may impose companies to give dividend. There are some regulations. For example, if you look at our commercial law, the commercial law in Rwanda, you cannot give dividend from capital, meaning you cannot use a stable policy because you can't give dividend from capital. You only give dividend from profit. So such regulations may impose companies on the policy to use in giving dividends. Okay. Then number 6, other points I think you can add. Debt covenants. Debt covenants. Debt covenants. Some debt holders may restrict the company to give dividends So some debt holders may give you money and they put conditions. And those conditions may restrict the company to give dividend to the shareholders. So those are what we can talk about. And there are other factors I think you can add on in the notes. So we can talk about dividend decision. Dividend decision. That's the subtitle. Dividend decision. These are decisions on whether the company should pay dividends or not. When it comes to dividend decisions, they are decisions on whether the company should pay dividend or not. And in this decision, they try to explain the effect, whether there is an effect or there is no effect if a company gives dividend or the company has not given a dividend. So in this,
sorry, sir, question.
Yes.
For the point number 6, debt covenant. So in which circumstance the debt holder may restrict the company to give dividend to the shareholder?
Those are agreements, because it's a covenants, they are agreements. You may want to get money from the bank, and the banker puts those conditions that if we are to give you a loan, you are not supposed to give dividend until you finish our money.
Okay, thank you very much.
You're welcome. Now, we are looking at the dividend decisions. And when it comes to dividend decision, we are saying their decision on whether the company should pay dividends or not. So these decisions, they illustrate.
It's point number 7.
No. This is the subtitle I said. Dividend decision. They illustrate the effect of dividend dividends on the company's value. We are saying that the dividend decision, you are trying to illustrate or to explain whether there is an effect if a company has given a dividend or the company has not given a dividend. So we have got two. We have got two theories that explains the dividend decision. We have got two theories which explains the dividend decision. The first theory, theory number 1, is what we call irrelevance theory by Modigliani and Miller. Irrelevance theory by Modigliani and Miller. If you read this theory, according to this theory, the dividend decision does not have any effect on the company's value. If you read this theory, remember we said our interest is to find whether the decision to pay or not to pay dividend has got any effect on the value of the business. So if you read this theory by Montigran and Miller, for them they say whether you pay dividend or not, there is no effect on the company's value. The shareholders or the company value will not be affected. Yes, please.
What do you mean in a brief company's value?
Of course, the value of the company is measured by the price of the share and the number of shares.
Is it irrelevance or irrelevant?
Irrelevance. Irrelevance theory. So the theory, of course, is based on assumptions.
It is irrelevant.
Yes. Assumptions of the theory. We can mention like 3 assumptions of this theory. One of the assumptions is that the shareholders are rational. Meaning that they aim at maximizing their wealth. One of the assumptions of the theory is that we assume that the shareholders are rational. Their main objective is to maximize wealth. And they are going to be indifferent on how they maximize the wealth. They can maximize the wealth by getting a dividend, or they maximize their wealth by having more capital or more shares. So as long as the shareholders maximize their wealth, for them they don't bother. Number 2 is that there is a perfect market. There is a perfect market. They assume that the market is perfect. That is a flow of information. Information in the market can flow freely. If you want to buy shares, you can get that information. And we can stop on number 3, but those they're not only the assumptions. There is no tax. They assume a situation where there is no tax. You can get a dividend tax-free. You can get a capital gain tax-free. So
is that a reality, or maybe
that's why they are called assumptions.
How do they assume something which is not reality?
You know, in the explanation of a theory, although we may assumption may have a weakness, but we look at its advantages and its disadvantage.
And that's why it's called an assumption.
Yes. Can we move on?
Please, yes.
Yes.
Yes, yes.
Then number 2 is the relevance theory by Gordon. Walter. That's number 2. The relevance theory by Gordon and Walter. According to this theory, the dividend decision has got an effect on the company's value. If you look at the relevance theory, the dividend decision has got an effect on the company's value. This is because the shareholders.
Mr. Can we come back for the assumptions? There's something I didn't note. The assumptions. If possible, you can scroll up. Yeah. Scroll up the slide.
Now, if you finish this, it becomes hard to scroll it. It can't. It can't scroll.
Is it right to...
Now, when you want to add something, it cannot. That's the problem with this whiteboard.
It is a perfect market. Yeah, it's okay. Yeah.
There is no problem.
Let me see if I can still send them to you.
This presentation after.
Okay, let me save them. Relevance theory by Gordon and Walters. And we are saying, according to this theory, the dividend decision. Who is that one? The dividend decision has got on the company's if you look at this theory, the dividend decision has got an impact on the company's value. And they say it is because shareholders
icya kabiri ni imfashanyo igihe umusazi yabuze imyenda yo kwambara yambaye ubusa bakaza bamuhereza inkweto n'imyenda nk'ubu nanjye inkweto ubu narazibutse.
It's our technology.
Jesus.
Shareholders discount dividends to determine cost to determine the share price. The reason behind this is that when shareholders are determining the share price, they are going to discount the expected dividend, or the shareholder discount expected dividends to determine the share price. So because the shareholders use dividends to determine the share price, if you don't give dividend, it means you are going to affect the price of the company. So in that case, there are going to be an impact on the company's value. Briefly, those are the main issues as far as dividend is concerned. Maybe other parts, we shall meet them as we are revising in the past papers.
So, sorry, question.
Yes.
What is the meaning when you say shareholder discount expected discount?
Expected
what
dividend.
Is the meaning of that? And again, what is the meaning of that? And again, when you say share price, what is it? And how share price it's found? Okay.
Yes, we have a topic on valuation. When we reach that topic of valuation, then we shall see how we get this share price using dividends. But in a dividend model, if you look at the dividend model, in determining the share price, what the shareholders do is to get the dividend they expect, and then they discount them. That is bringing them back to their present value, and they determine the share price. So we can now move on. And these are not very common parts in exam, but you never know. Dividend, capital structure, they are not very common.
Then we have to pass by.
But they are not very common parts, but we just have to provide the knowledge on them, such that if you meet it, you know what you can write.
We should use a very limited time on this, maybe.
Okay, that's why I'm moving fast. Capital structure. When it comes to capital structure, it is the combination of debt and equity. If you look at your capital, how much do you have as debt, or how much do you have as equity? That is going to define your capital structure. Amount of debt.
Is this a new chapter?
That is a new part, a new chapter. That is, you're looking at amount of debt or amount of that you have in the capital in your capital structure. Is it okay? So another important is what called the gearing. We've been talking about this word, gearing. I think we defined it, the gearing, because we are going to be using these words too much in this part. The gearing. What is gearing? Gearing is the level of debt in the capital structure. The level of debt in the capital structure. So if you are financing with a business, if you're financing a business with 10 million, so then we are going to look at, of this 10 million, how much is debt, how much is equity. So that is going to define the level of gearing of the debt. Now, the higher the debt, the higher the gearing. The higher the debt, the higher the gearing. If the business has got a very high debt in its capital structure, then we say that business is highly geared. If the business uses little debt, then we say it is not highly geared. If the business does not use, because we are going to be using these terms, if the business does not use debt, then we say this business is not geared. We call it an ungeared business. So I think I should write those words, because we are going to be using them. The business that uses a debt is referred to as a geared business. Similarly, the business which does not use a debt is referred to as an ungeared. We are going to be using this word so much, an ungeared business. If you have a business and that business you are not using a debt, we call it an ungeared business. If the business is using a debt, then we call it a geared business. Now, how do we measure gearing? To measure gearing, we saw this one in our introduction. Gearing will be equal to market value of debt, divided by market value of debt plus market value of equity. If you want to measure the gearing, you are going to look at the market value of the debt divided by the market value of debt plus market value of equity. And we said if the ratio is high, it means the business is using much debt. If the ratio is low, it means the business is using less debt.
So question.
Yes.
What do you mean when you say market value of equity? The meaning of that, and if possible, if there's a calculation,
The market value
which
of
can
equity,
be done.
you're going to get the market price of share times the number of share. Then you get the market value of equity. Is it okay? Say market value of debt, we are going to get the price of the debt times the number of debts you have issued. Then you get the market value of the debt. Is it okay?
Yes.
Capital structure theories. Please switch off your microphone. Capital structure theories.
Excuse me, before you go to that point,
yes,
I would like to know the
what?
Negative effect of
Effect of what?
I'm not getting you, please.
I'm not getting the effect. The question well. The effect of who?
Of not being geared for a company. You know, there might be a situation where the company is not geared. What is the negative effect of being in that status?
No, it doesn't exist.
Yeah, there are some business which uses 100% equity. I don't see any effect. Maybe you are not be able to maximize your value well, but I don't think there is a big effect on that. There is no big effect on that.
Okay.
Excuse me. I don't understand where the formula market value of debt over market value of debt.
Yes, plus market value of
debt
plus.
One. I think we give one.
Huh?
I don't understand where the formula.
Maybe if I say my market value of debt is 10 million.
Yes.
Market value of equity is 5 million.
Maybe you may have put the brackets.
That is it. Market value of debt is 10 million. Market value of equity is 5 million. So what is the gearing here?
10
gearing
10 over 15.
10 will be 10
over 15.
10 over 16.
Over 15.
10 over 15.
Yes.
Yes.
We hello.
Yes, please.
What?
Excuse me, sir.
Yes, please.
May you illustrate more on those formulas you're using?
How Kawesigire? Because Janet, I think I can read that one. Janet.
Yeah.
Yes.
Yeah.
So if we look at this, you are getting the market value of the debt over your total capital. That's what it means.
Okay.
Yeah, over your total capital, which is equity plus debt. So let's look at the capital structure theories. I'm having a class of many, and the list is very small. I don't know. Others, whether they are customers or they are not customers. So the capital structure theories. So the capital structure theories, they try to explain whether a combination, whether the way the company finances its operation has any effect on the company's value. Any effect on the company's value or on the cost of capital. So if you look at these capital structure theories, they try to explain whether the way a company finances its operation, that is whether you are using a debt, you are using equity, or you are combining a debt and equity, has got any effect on the company's value or on the company's cost of capital. Whatever we are going to discuss in these theories, we are trying to provide an answer on this question, whether the way you finance your business really matters. Does it matter the way you finance your business? Whether you are using equity or you are using debt, does it have any effect on the value of that business? So that is the question we are trying to answer in the capital structure theory. And we have got
Can you please go back 1 minute?
Excuse me, lecturer. Are we supposed to write what you are writing?
These are summaries which can help you in your reading.
We can go on, thank you.
Yeah,
but I think you can share us. It's better. You share them after lecturing.
Okay, but since you have the video can also help you. But these are simple. It's better to make some notes.
Those one who are not working,
it's better to make some notes because these are summaries of what you have in the notes. Like in the last minute, you cannot read the notes. You only need to read the summaries, isn't it?
Yes, but if it is possible, you can share those summaries as they go very quickly.
Let's move on.
Let's look at the first theory, the traditional theory. If you look at the traditional theory, according to the traditional theory, I can summarize. According to this theory, capital structure and the value of the are related. The company's value is determined at the minimum point of the cost of capital. So in summary, if you read the capital structure, the traditional theory, you find that in a conclusion, they say that the capital structure and the value of the firm are related, meaning there is a relationship between the way you finance your business and the value of the business. And that part, the value of the business, you can determine it at the minimum point of your cost of capital. I can draw a small illustration to illustrate this. So if I have this, this whiteboard is not working. I need a pointer. How do I get a pointer? A draw.
There is a pen somewhere.
There is a draw here, I think.
Yeah, you can see it on my screen.
Which one? Which one?
A pen, something like a pen.
The other one up.
I'm using my Samsung. Yes, that one.
Okay. My friend, the diagram is it's like this.
Yes.
It's like this. This is my cost of debt. Then this is my cost of equity. Now, at first, the overall cost of capital is reducing. Then an increase in the cost of equity and the cost of debt leads to an increase to the overall cost. This is my wachacha. At the minimum point here, this is where you can determine this is gearing.
Level of gearing.
This is gearing, and this is the cost. So that's the explanation. That is the explanation by tradition. So they say that at the first, the cost of equity and the cost of debt are constant because the equity holders are enjoying the benefit of using a debt. But as you are increasing more debt in the business starts to become risky. As the level of gearing becomes high, the business becomes risky. So when the business becomes risky, the debt holders are going to increase the interest. So when the debt holders increase the interest, the cost of debt will increase. So as the business becomes risky, equity holders will start demanding a high return. When they demand a high return, the cost of equity also increases. At first, the overall cost of capital is reduced. At first, the overall cost of capital is reducing. But an increase in cost of debt and the cost of equity leads to an increase in the overall cost of capital. So at the minimum point, that's where you're going to determine the company value. So in the conclusion, capital structure and the value of the firm are related. I can put some simple explanation on this diagram here. At first, the overall cost of capital is decreasing. But as the company increases or uses more debt, the debt holders demand a high return. Which leads to an increase to the cost of it. So as the level of gearing, increases, equity holders demands a high that increases cost.
Is the equity holder. It is equity holder.
Equity holder. And the heighten that the cost of equity. Now, an increase in the cost of debt, if it increases the overall cost of the watch the value determined.
Excuse me, lecture.
Yes.
Is the debt holder or is the debt giver?
Debt holder.
Who demand a return of capital?
That's it become a debt holder.
Demanded the return of capital.
Yes, determine the minimum point.
Sorry, we don't see the very well the explanation, those explanation.
Huh?
We don't see it. We don't see it the screen for where you write the explanation.
We're not seeing that. We're not seeing.
Don't see if you can repeat from the first sentence for at first the overall cost.
The overall cost of capital is decreasing. This one, this is the gap. At first, is decreasing, but as the company uses more debt, the debt holders demand a high return because the business starts to become risky. So the debt holders start to demanding a high return, which leads to an increase in the cost of. When they demand a high return, the cost of debt will increase because of the increase in that return. Now, as you are increasing more debt, you are because of high leverage or high gearing. So high gearing causes an increase in the cost of debt, the cost of equity. Increase in the cost of equity and the debt is the one that causes an increase in the overall cost of capital. So at the minimum point of the overall cost of capital, that's where you determine company value.
Excuse me, lecturer.
Yes.
I have two questions. The first one is, it seems the equity holders demand high return, or is it profit? High return they are demanding.
Yes.
As the sorry?
Yes, it is a profit.
It seems that they are demanding a high profit.
Yes.
As debt holder increases the gearing, the level of gearing.
When you increase because what makes an issue is that when you increase the gearing, the business becomes risky because of a high debt.
Mm-hmm.
The business becomes risky. So when the business becomes risky, because we know that the higher the risk, the higher the return. The higher the risk, the higher the return. So when the business becomes risky, the equity holders and the debt holders are going to demand a high return to compensate them with the risk.
So my second question is about the last sentence, which is not clear. Maybe it is I have an issue of English. The value is determined at the minimum point of work.
Yes.
I understand what is the work, but what is confusing to me is to say determined at the minimum point of.
That is economics. This turning point, economists, they call it a minimum point. The turning point of this curve. That's what economics is, the minimum. Isn't it? It's like that?
Okay.
Yeah. Can we move on?
Yes.
Yes, sir.
Turangije meeting.
Let's look at another theory, which is Montegren and the Miller. We abbreviate as MM. The MM. theory. Gaspard, your microphone. Montegren and the Miller advocated for position from two theories, which are now let's look at the Montegren and the Miller theory. The Montegren and the Miller theories, they advanced, or they came up with two theories. Four preposition, but these four preposition are from two theories. And in the first two, in these two theories, we have a tax-free economy and a taxi economy. They are looking at a capital structure, the way you combine in a tax-free economy and in a tax economy. Now, if you look at the first one, the MM in a tax-free economy. The Montegren and the Miller in a tax-free economy. Under this theory, Montegren and the Miller assumed a situation where there is no and came up with two prepositions, which are MM1 without tax and MM2 without tax. both preposition.
MM1 is not well written.
MM1.
Yes.
In both preposition, Modigana and Miller concluded that
Preposition or it is a proposition?
Preposition.
If you read the above sentence, sorry?
Concluded that capital structure and value of the firm are not related. If you look at the Montegrana and the Miller, in Montegrana and the Miller,
what do you mean by a preposition?
They came up with two prepositions. They first analyzed a situation without tax, and then they made another situation without tax. They made two analyses. And if you look at MM1,
Excuse me, what do you mean by preposition?
Like issues. MM1 without tax.
Okay.
If you look at MM1 without tax, they say that the value of a business that is geared is equal to the value of a business that is not geared. As long as the two businesses are in the same class, a value of a business that is geared will be equal to the value of a business that is not geared.
Sorry, sir.
Yeah?
The MM2 also is without tax.
Yes, please.
Or is with the tax?
No, without.
Okay.
Without. Part of a geared business is equal to value of an geared business. An geared business. As long as the two businesses are in the same risk. Yes, please.
I think that word is not preposition, it should be proposition. It comes from propose.
No, it is written as preposition.
From the books?
Huh? Yes, sir. So what is here is that if you look at their analysis of this situation, yes, Dative, you have raised a hand, and Dative, I'm seeing your hand. Dative.
I beat it by accident.
Huh?
Maybe raised it by accident.
Okay.
So, sorry, question.
Yes.
Question.
Yeah.
It is possible that the value of joint business and the value of unjoint business can be the same or related.
Yeah. Let me give you an example. According to them, what they say. If I have two business, let's say you are having two business. You have business A and a business B. These two business, they have purchased a motor vehicle. Is it okay? The two business have purchased a motor vehicle. Business A has used the debt, a debt of 90 million. And this one has not used the debt. Equity. This has used 10 million. This has used 100 million. What is the value of the vehicle? Based on Montegrano and Miller, what is going to be the value of the vehicle? Yes? Hello? What is the value?
Yes, sir.
What is the value of this vehicle for both businesses?
100,000.
100,000.
Is there any difference in the value? The difference is only how we financed. But at the end, the value is the same.
Yes.
Maybe if it was in a advanced corporate reporting, I would have gone deep to prove this. You can prove it.
Yeah.
And you can find that there is no difference. I can prove and find that there is no difference in this value.
But you can also prove and you find there is a difference.
No, if you no. If you follow them, you find that there is no.
Because one financed by debt and is financed by equity.
Yeah.
The value does not change.
But not the value, but the source of financing.
No, it is not. So at the end, you will come and find that the value of a GRD business is equal to the value of an GRD and a GRD. Another expression is
Rector, it seems the meaning of the concept preposition is not fitting well to me.
Yeah.
You've said that it is an issue.
Yeah.
Preposition means issue.
That's,
problem.
Yes.
So
But
that means that that means that these guys comes with two issues.
Yes, two issues related to task free, and we are going to look at each. So
okay,
and this is the first issue. That's their conclusion. Now,
Excuse me, sir.
yes, please.
What is the difference between MM1 and MM2?
That's what we are going to look at. In the conclusion of this, they gave another example. If you read their theory, they gave an example. If you have a pie, you know a pie. The way you slice your pie, does it increase its value? Or you can put a chapati maybe in our. I think we don't have pies in Rwanda, but we have chapatis. The way you slice your chapati, does it increase its value?
You go in the market, one you can sell it at a big price.
Yes. At the end, you are going to have the same. Whether you have cut 10 pieces, it's going to remain one pie or one chapati. That is the Montegrano and the Mira. That is one. Now, the second one is what I want us to, because the second one helps us to develop the MM2 with tax. which we need to put into consideration very much.
Excuse me, sir.
MM2. Yes, please.
Go back the first, the what? Where we were.
Here.
Yes. Yes, I was asking.
Yes.
This MM1 is under the tax-free economy.
Yes.
Where what we are under the tax-free economy.
Yes, please.
So you mean under the tax-free economy, there is MM1 which is with tax and MM2 which is without tax.
No, 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 no.
So these MM1 are without tax.
They are all without tax. They are looking at two situations where there is no tax.
Yes.
Yes.
So who was asking you, and you said MM2 is with tax, and that's where I was confused. Confused.
Can we move on now?
Yes.
Let's look at this one. We need to move fast. MM2. This is very important because we find it in other parts. MM2 without let me see the charts. MM2 without tax. Now in MM2, the F and the mirror incorporated the benefit of tax. Are you together? M2 without tax, Modigliani and the mirror incorporated the benefits of using a tax, in the business, of using a debt in the business. They incorporated the benefit of using a debt in the business. Since the debt is cheaper compared to equity, the equity holders
compared to
are compensated.
Not there.
Yes?
Compared to, not compare the equity.
Compared to equity, the equity holders are compensated with the benefits of cheap debt and thus the overall cost of capital remain unchanged.
It is cheap debt. You've omitted debt. Cheap debt.
Oh, good, mister. So if you look, this one, we are going to apply it in other parts. Please you need to understand it very well, most especially when we go to adjusted present value. So I'm drawing which diagram am I using?
So that means that if the cost of capital remain unchanged, it means the high cost of equity is compensated by low cost of debt.
Let me explain this by after doing this. This is the cost of debt. This is increasing. So when you are drawing it, debt has been increasing. This is the cost of equity, which will be equal to the cost of ungeared plus cost of ungeared minus cost of debt into debt divided by equity. This is my wachacha. This one is the risk premium. Now, this one, I think it's the one that you have in your notes. This one. Now, if I look at this, as I was saying, this is our cost of equity. Please draw it very well to show that this one is increasing. This one is constant. This one is constant. This is our gearing. This is gearing, and this is cost. Now, you are financing a business using both equity and a debt. The moment you introduce a debt, because debt is risky, the cost of equity increases. But the debt is considered to be cheaper than equity. So the more you increase the debt, you see this gap increases. As you increase more debt, this gap increases. So, but the equity holders are compensated by a cheap debt, which is cost of ungeared minus the cost of debt. It gives us the cost of the premium that the equity holders are given. So because the equity holders are compensated here with the risk they are incurring when you increase the debt, you find that the overall cost of capital does not change. And in conclusion, there is no effect of capital structure on the value or on the cost of capital. I don't know if you have a question.
Why do you say that it is the debt, the increase of debt, while in the diagram it it look like a cost of equity that is increasing.
No. As you are increasing more debt, you are increasing the gearing. Is it okay? The cost is remaining unchanged. The cost is constant. But as you are increasing more debt in the business, you are increasing the level of gearing. As you are increasing the level of...
What is that top graph?
Yes, as you are increasing the level...
What is that graph on the top?
This is the cost of equity.
Yes.
Yes, as you are increasing the level of gearing, the equity holders demand a high return. So when the equity holders demand a high return, the equity holders are compensated by a cheap debt, because the cost of debt is cheaper than the cost of an geared business. So this compensation is the one that makes the overall cost of capital not to change. Yes, Janet. Janet.
Okay. I'm asking.
It is not clear.
Excuse me, sir.
Yes.
You have said that you don't see any effect as you are increasing the cost of debt. Yet in this graph, when you are increasing the cost of debt, the risk premium will be high. Then why are you saying that there is no effect?
No, because this risk premium is given to equity holders. You are increasing the debt, but you are increasing the benefit of the debt, which is measured by cost of ungeared minus the cost of debt, which is given to equity holders. Because the equity holders are compensated this risk, the overall cost of capital remain unchanged.
The cost of capital remain unchanged?
Yes, does not change.
Okay.
How cost of debt remain such as remain on the line, straight line? How? And it's a cost of debt.
Why the cost of debt remain unchanged? It does not change. So in this Modigliani and Miller theory here, we assume that you can finance the business using a debt or using equity, and there is no effect. But what happens is that as you are increasing more debt, the cost of debt is not going to change. You are going to ignore the risk of using more debt. But what changes is the cost of equity. When you introduce the debt, the cost of equity increases because of the risk of a debt. But the debt holders are compensated.
None se niba wongereye ideni nigute cost itazamuka kandi wongereye ideni.
Uyumve gute? Wongeye ideni ariko tuvuge deni uri kurifata kuri cost y'icumi. Uri kumva? Edeni uri kurifata kuri cost ya 10. Ariko cost of ungeared iri 15. The cost of ungeared iri 15. No kuvuga ba equity holders, you are going to compensate them. Kubera area debt iri cheap.
Excuse me, sir. Do you see it in the short run or in the long run? Do you see that effect in the long run or in the short run of the business?
In that case, there are a lot of course, there are a lot of assumptions that are made. There are very many assumptions which are made on this theory. But when we are explaining the theory, we ignore most of the assumptions that are made. But the theory is based on assumption.
So question.
Yes.
How is the increase in the debt can lead to the benefits obtained by the investors?
Reka tuvuge urugero.
Yego.
Urugero navuga nuru. Cost ya debt. Tuvuge ubona debt ku 10%. Sibyo?
Yes.
Ubona equity kuri 15. Which one are you going to use to finance your business?
Of course, debt.
Or you are going to use a debt.
Yeah, because it is cheaper compared to equity.
Which is by 5%.
Yeah, the difference, which is a risky premium.
This is going to be the risky premium. So as you are increasing more debt in the business, the equity holders will be enjoying this premium because the debt is cheap. Is it okay? So because they're enjoying this, they are not going to this overall cost of capital is not going to change because the equity holders are compensated and this one is constant. So it means when you compensate, you close this gap. So when you close this gap, you find that at the end, equity is constant, debt is constant, and the overall cost of capital is constant.
But sir,
yes,
is this cost of debt in terms of dividends given to the investors? How is the cost of? We know that equity is the money owned by the owners of the business.
Yeah, remember.
What is this cost?
Were you around in yesterday's class? Because yesterday we discussed this. Yesterday's class.
I was around.
You were around. But we discussed the cost of debt, we discussed the cost of equity. The minimum that you need on your money, that's the cost. If I'm to give you...
That's dividend.
Not maybe a dividend. Yes, for the shareholders, it can be a dividend and a capital gain. Isn't it, for the shareholders? For the debt, it is the interest.
Okay.
It is the interest.
Yeah, for debt.
For the debt, it's the interest. Yeah.
Another question.
Yes.
Explain me why now the graphic, you see that cost of debt are straight and for why ACC are also straight. Explain me why. I like the same.
That is what I've written here. And I said, since the debt is cheaper compared to equity, the equity holders are compensated with the benefits of cheap debt, and thus the overall cost of capital remain unchanged. That's what I've written.
But explanation, why even at the end, it can't, why even at the end, not any small, even small increase? Why? You see that cost of equity increase until at the beginning is straight, but when they end, they increase. Why that is straight only from the beginning at the end?
Because the issue is about a cheap, that the debt is cheaper than equity. That is it. Because it is cheap, the equity holders are going to be enjoying by financing using a debt. Can we move on, friends? We need to finish this part.
Excuse me,
Yes,
sir.
please.
Yes.
Yes,
Any, the
please.
meaning.
What is the meaning
Yes,
of who?
your meaning, your meaning that the equity holders will enjoy the benefits of the business using the debts.
With the benefits of using
And that it will compensate. They will enjoy the benefits of a business using a debt because the debt is cheaper than them putting in their money. It will be expensive.
Yes. If you are comparing,
When they put, if they put on their own money, it will be expensive. But if they acquire a loan, it will be cheaper than putting in their own money. So this is that's where they get the risk premium, because putting in the debt, they are not investing in their own money. They are gaining the benefits, not investing much money.
yes.
Okay, thank you.
So can we move on to Modigram and Mira in a taxi economy?
Yes.
Hey, this was challenging, eh? And now we are going to another challenging part. MM in a tax economy. After allowing, please, this is very critical. This one is very critical to when we are calculating adjusted present value in investment appraisal. It is very, very critical. Please try to get it from here. When we reach there, it won't disturb you. It is very critical when we are calculating adjusted present value, because we use Modigram and Mira in a tax economy. So please try to get it very, very well. And I'm worried. My worry is that this time I'm expecting a question to come on adjusted present value. That's where I'm expecting. So please, we need to understand this part very, very well. After allowing for taxation, Modigram and Mira concurred with the traditional theory, that capital structure.
This one is after allow.
After allowing
for
for taxation. Modigram and Mira concurred or agreed. Agreed.
After allowing for
taxation. Modigram and Mira concurred with the tradition or agreed with the tradition that capital structure and the value of the farm are related. After they allowed for tax, the Modigram and the Mira agreed with what the traditional school had seen before, because they agreed this after around 10 years. After 10 years, after around 5 years, after 5 years have passed, that's when they agreed with what the traditional had seen, that capital structure and the value of the farm are related. But they only agreed that after they have incorporated the effect of tax. Without tax, there is no they don't agree with with the tradition. But when they incorporate tax, then they agree with what the tradition said. So we still have MM1 with tax. Remember MM1 without tax? You remember? MM1 without tax. You remember?
Yeah.
What does it say? MM1 without tax.
The value of GRD and GRD, the value of business of GRD business and GRD business are the same.
Yes, that is the MM1 without tax. The value of an GRD business is equal to the value of a GRD business.
GRD.
Is it okay? Please, I want you to master
Yes.
this part because it will help us in adjusted present value in investment appraisal. Please master this. So after allowing for tax, after allowing for tax, MM found that the value of a GRD business is higher than the value of an GRD business with the present value of debt tax shield. Present value of debt tax shield. Thus, capital structure and the value of the firm are related. So in this case, the value of a GRD business will be equal to value of an GRD plus the present value of debt tax shield. This is because the interest on the debt is tax deductible. The value of the business is maximized.
Yeah, it is after allowing for tax. You've omitted the tax.
At a point where the business uses 100% debt. So this is the multigram and the mirror when there is tax. And what makes a difference in their theory is that the company which uses a debt will always enjoy a tax benefit on the debt because the interest on the debt is tax deductible. So because of this tax benefit the firm enjoys, you find that the value of a business that is geared will be equal to the value of a business that is not geared plus the present value of the debt tax shield. Hope this one is not confusing.
It's confusing. I want to know exactly when you say present value debt tax shield, and you say how you say that is the difference between value yield and value unyield. Thank you.
Now, when you are paying an interest, the interest on the debt is tax allowable. Because the interest on the debt is tax allowable, you pay less tax compared to a business that uses a debt. I mean, that does not use a debt. Let's say, for example, I have two businesses, business A and I have business B. This is my PBIT, profit before interest and tax.
Tax sheet
This is 10 million.
of a debt on tax sheet.
And even here it is 10.
Present value of debt of tax sheet.
Of a debt on tax sheet.
10 million. This one is geared. This one is a geared business, and this one is an geared. That one is an geared business.
Present value of
present value of a debt on a tax sheet.
Present value of
debt on a tax sheet.
So we are looking at two businesses. This is a geared business, and this one is an geared business. So this is my profit before interest and tax. It means for geared business, maybe we are having an interest. We are having an interest of 2 million. Here, Since it is ungeared, there is no interest. So my profit before tax here, profit before tax, this is going to be 8, and this is going to be 10. If I calculate tax here, 30%, this is going to be 2.4. This is going to be 3 million. So you see that the business which is geared is paying less tax compared to the business that uses that is ungeared. This difference in tax is the present value of the debt tax shield. This one, the difference here, the 3 minus 2.4 will be the present value of the debt tax shield. That is what the geared business enjoys, which the ungeared business does not enjoy. I don't know if it is okay there.
Excuse me.
Yes, please.
If this business that is geared enjoys that benefit of the deduction on the tax,
yes,
because the interest is
tax allowable.
We say it is tax allowable. That means that the value of the business of a geared is higher than the value of business that is geared is higher than the value of the business that is ungeared.
Yes, to get a value of a business that is geared will be the value of ungeared plus what that tax shield.
But this shield will also be paid as an interest on the loan.
It means the equity holder are going to have the business which use debt, they are going to enjoy that.
Yes, yet they will pay the interest of the loan.
Yeah, they are paying the interest on the loan, but the money is not theirs still. The money is for the other people.
Oh. Yeah. So the money is not theirs. That's why they enjoy.
Yes.
Okay.
Iyi difference irimo aha ngaha niyo bita present value of tax sheet.
Yes.
Yes.
That means when they be calculating, like these equity holders, when they be calculating their dividends, they want to deduct the interest that were paid on the loan.
No, they don't, because they don't use it, and yet they don't have.
Yeah.
Yvonne.
No, I'm meaning this year. No. Because we are saying they're enjoying this interest that the tax deduct for them.
Yes.
That means when they are calculating their dividends, they will calculate before they pay the interest.
No, they are going to calculate after they have paid the interest.
So how do they benefit? Yet the
are benefiting by paying less tax. They are benefiting by paying less tax.
I'm confused in this way. They are benefiting, I understand. In Rio, are they benefiting? Because this deduction will be paid as the interest. Are they benefiting? Yet this deduction on the tax is paid as the interest on the loan that they acquired.
The answer, based on me, how I understand it, the answer is yes. Because, you know, if you have a tax, what does it mean?
Mm-hmm.
If you are using a loan,
mm-hmm.
and the interest on that loan is allowable. It means the government pays for you 30% for you to use a loan. For you only pay 70%. So it means you're going to be enjoying this, what the government is paying for you to use a loan. So I would conclude.
The confusion lies. The confusion is lying where you say that you're enjoying, yet you're again paying the interest of the loan.
You are enjoying.
That's why I'm confused.
You are enjoying that the interest on the loan is tax allowable. That's what we enjoy.
Oh, okay.
The interest on the loan is tax allowable expense.
Yes.
Yes, Yvonne, I saw your hand. Is it okay? Davy or Davy? Davy.
Yes, lecture.
Yes, I will see your hand.
Yes, I want to ask one question.
Yes.
Here we are in fact of measuring the value of a farm.
Yeah.
And we are measuring the value of a farm by using a profit. While last time we taught us how to measure the value of the farm by statement of financial position, legal basis, and market value. While today we are measuring the value of the farm by using profit, as well as this example.
The issue is on the value of the business by using the other items that we discussed in our introduction. Yes, I don't disagree. I agree that when we are measuring the value, we look at the price of the share times the number of shares. So, yes. But in most cases, the company shares comes from what is going to drive the company share is going to come from the profit. If the company is not making a profit, if you are using the balance sheet item, if the company is not making a profit, automatically it is almost a dying company. So the shares will not be selling at the market.
Okay. That relationship. Thank you.
Can we move on to MM2? This was MM1.
For me, I think that this theory can be valid percent by it is not 100%, but the theory cannot be valid.
The main weakness is this, that you maximize the value if you are using 100% debt. For me, that's why I'm seeing the weakness. To be able to get this value, you must be using 100% debt. Is it possible the business can reach this point 100% debt without bankruptcy? That's where the challenge is on this theory. We ignore the threat to bankruptcy.
No.
That you can continue financing the business until you reach 100% debt. That's where you're going to maximize your value. It's a challenge on the theory.
Unless it is maximizing the value of the company in dying.
So that's where the weakness is, but we cannot ignore the fact that the theory is applicable. So we go to other part, and I want now to look at Modigliani and the mirror 2, still with tax. This is the one that is usually examined. Modigliani and the mirror 2 with tax. You remember Modigana and the Mira 1 with Modigana and the Mira 2 with tax, without tax. Do you remember? Hello.
Yes, we do.
What was the issue there? What makes a difference?
They incorporated the benefit of using tax into business.
The benefits of using a cheap debt. That was the main issue. The benefit of using a cheap debt. And because the debt is cheaper than equity, the overall cost of capital don't change because the equity holders are compensated. Now, if you come to Modigrana and the Mira 2, to Yaro, your microphone. When you come to Modigrana and the Mira 2 with the tax, they combine two things. They combine the benefit of a cheap debt and the tax benefit on the interest. So when you combine the two, the tax benefit and the cheap debt, you find that the overall cost of capital will be reducing. So this combines the benefits of using a cheap debt and the fact that interest on debt is tax allowable. So the equity holders are compensated by the cheap debt and debt tax shield. Which leads to a decrease in overall cost of capital. Thus, capital structure and cost of capital are, so that is the MM2. It comes from MM1. If you remember the MM1 without tax. So from MM1 without tax, that's where we get the MM2. We can
that is a cheap debt.
We can draw this
by compensated by the cheap debt. Eh?
Yes, by cheap debt. Yeah, you can add that. That if you have a question? That if so this is the MM2. The important part is to understand, to get this formula and put it in your head, because it is very, very used when it comes to other parts we shall discuss. The MM2 without tax. And
excuse me, sir.
Yes.
This is power D over what? Over cost of capital.
There is no power. It is cost of ungeared plus.
And it's 1 minus T. Then
1 minus cost of debt. This is K. 1 minus cost of debt into 1 minus.
And then after?
Into 1 minus T.
Minus T.
1 minus T. Where T is the tax.
And this
over equity.
Let me change the variables here. KE is cost of equity. Cost of equity of geared business. KU, cost of ungeared business. KD, cost of debt. T, tax. D, value of debt. And E, value of equity.
Thank you.
It's okay there.
It's okay.
Excuse me, Mr. Daniel.
Yes, please.
I found this part of capital structure and where we ended the cost of capital yesterday. It looks a bit tricky.
Yeah.
We'd like to have some examples, worked examples, or will rehearse more on it so we can understand it.
The bad thing is that the capital structure is purely theoretical.
Okay.
The formulas are just to help you to understand, but there is no calculation question that comes in I on capital structure, which is computation. Maybe in advanced you can find in advanced corporate reporting, they can tell you to prove this, to prove that this one. But in I, no. As long as you get to understand the concept, it becomes okay. It's not computation. These formulas are just to explain, to help you to explain. But this formula is mainly sometimes used in the or this concept of Modigan and Miller with tax. They are mainly used in the adjacent present value. So that's why I said you should get to know them.
We would also need to be directed on how these two chapters are tested in the exams. Where do we need to put more effort?
As I said earlier, the more we part with is the cost of capital. These ones have not very rare to have a question on it, but it doesn't mean that you don't need to read them. But the cost of capital is almost 90% certainty, 90%. So it means you need to make more effort on cost of capital than these ones, but it doesn't mean you don't read this. So, but when you are giving more weight, give more weight on the cost of capital.
And some books, they combine them. Cost of capital and the capital structure, it's like one topic.
But that will be, no, they can't be one topic. They may not be one topic. It is the oversimplification, maybe.
Thank you.
Welcome.
Please, this is 1 minus tax, or is interest minus tax?
1 minus tax.
Another question, please.
Yes, please.
How do you intend to teach? Because are we covering a topic and we revise some questions in the past paper, or we'll have?
I think that is what we did yesterday. After completing the topic, instead of doing the class exercise, we go to past paper question. I think that's what I did yesterday. After finishing the cost of capital, we went to do questions in the past paper on cost of capital. I think we did 3, we did 2. We did 3 questions on cost of capital.
We did.
Huh?
I attended 2.
Huh?
I did attend 2 questions, but if you sharing these videos and notes, we can catch up.
Okay.
I don't know how you're sharing these because they are very heavy. On email, they cannot be sent.
I don't know now. How am I going to share them? I'm not an
possible?
Huh?
Is it possible on WhatsApp group if you compress them?
Then it means I need to get some IT people to help me to compress.
Yeah, otherwise you cannot upload them on email. They are very big.
They are very big because those are.
Yeah.
Maybe we need to be dividing it. Every 1 hour we pause it. Huh?
I don't know how you're going to share this, because we would like to have notes and this, and then we are starting from home individually, so it becomes hard to revise and to be on the same level.
Yes, I understand, but now, like now sharing this video, I'm taking the video. So I'm not an ICT person that I can compress the video. I don't know how to compress. But
So what you can do is you can edit them and you remove these noises, unnecessary voices, and then you upload them on YouTube.
I put them on YouTube.
Yes.
YouTube also, if it is too heavy, they don't allow. Because I have a channel on YouTube. It would have been very easy for me to put there these notes on YouTube.
You can upload what you can, and others you can share on emails.
Okay.
But the yesterday Excel workings are very needed.
I think I sent them.
Oh, let me check on the email.
Yeah, the Excels were sent yesterday.
I haven't got anything from you. Maybe I need to share with you my.
Yes, I didn't get them.
So the Excel sheet was sent yesterday, immediately.
Through our WhatsApp group, I remember.
It was
guys,
on
you
WhatsApp
should
group.
check in
Yes.
WhatsApp group.
Yeah.
But we are not on the WhatsApp group, all of us.
Please,
who is responsible to add the new members?
Tell the administrator to add you.
Sorry, I didn't hear you. Your voice is breaking.
You tell the administrator. I'm not the administrator, but you can tell the administrator to add you.
Help us.
So put your
you can ask Mr. Felix. He can help. He can help. He's the admin of that WhatsApp group.
So you can.
Thank you. I will contact him. Thank you.
Okay.
So what is the best way to reach him, because some of us don't know Felix?
Okay, I think it is better to put your number in the chat room. I think he can get it.
We normally do that, but maybe he has less time to check. So we would look for the best way to reach him. Otherwise, we have been asking for that for quite a while, but nothing is coming.
I think Mr. Felix can.
So I wanted to end this class by looking at something. It means our next class will be on investment. We still have a very big load. Maybe in the next class we shall plan some private classes. Isn't it?
Tomorrow is a holiday.
Tomorrow is a holiday, but my day is already taken tomorrow.
Oh, sorry.
Yeah. My day is already taken.
Maybe after the government resolutions on this COVID, we can arrange. Maybe maybe I think on Wednesday evening you can have a class if all agree.
We can make arrangement, then we can see. Because this course is very wide, yeah? Very wide and complicated.
We have another class.
Okay, we shall plan another week.
Okay.
We shall plan another week.
Another class.
This part, I think I was supposed to discuss it under capital asset pricing. But I skipped it. and it is very important in some cases. The difference between the equity and the asset beta. When you talk of equity beta, equity beta is a beta of a geared business, and asset beta is a beta of an geared business. I'm happy this will help us in some questions that we shall do, especially on adjusted present value. How do we adjust equity beta and how do we adjust the asset beta? Now, if we have an equity beta, or if we are calculating the cost of an geared business, we need to use an asset beta. But if you are calculating the cost of a geared business, then you need to use equity beta. I think I can make a simple note. When computing the cost of equity, a geared business, we use the equity beta. Clearly? In computing, when computing the cost of an geared business, we use asset beta. So if you're getting the beta, I don't know how to put this formula, the asset beta, because I don't, or I can use the word asset beta. Maybe I shall get to know where to get the symbols. The asset beta will equal to value of equity times equity beta times equity beta. Then I divide by value of equity plus value of debt into 1 minus t. VE is the value of equity. VE is value debt and T is the tax. So you can use that formula. We shall be using it in our discussion how to do adjustment in these issues. So members, I think we are stopping here. I want to take the attendance. I want to take the attendance. Yesterday I didn't take. I'm going to combine the two. So I will beg the pardon if I pronounce your name wrongly.
We sometimes we join with other names.
Oh, I'm just reading on the list. And I'm taking now, if you have attended the four classes, you take, because this is my fourth class. So if you have attended the 4 classes, you tell me that you have attended the 4. Yamulemi, Yamulemi. Yamulemi, are you there?
Mention another name.
Yamulemi, I may Felicier.
Felicier.
Yeah. Is it there? Angelique Akayezu. Angelique. Alice.
Present.
How many classes?
From when?
This is the 4th class. How many have you attended?
This is my first class.
She's being innocent.
Angelique Elambona. Angelique. Biata. Uimuwe. Biata. None se abari kuri abari kuri ni abahe
customers.
These are unnecessary customers.
Unexpected customers.
Customer bari kuri platform ni abahe
Uninvited customer.
Birashoboka. Owasenga Christian. Owasenga? Tuyizere Christian Steven. Brody Burume.
Angelique is saying she's there because she has an issue of a microphone. She typed.
Angelique who?
Yes. She typed, she doesn't, her microphone, she has an issue of a microphone.
Dufite abakasitoma benshi ariko abatari abacu. Uwizeye Clemence. Uwizeye Clemence? Dative, I think Dative I've been seeing her. Dative. Dave, I think I've also seen him. Emmanuel. Gaspar, I think I've been seeing him.
Another name of Emmanuel.
Emmanuel, Nirenganya. Nirenganya. Is it there?
Yes.
How many classes?
2 classes.
4.
2.
Zambere nago.
Yes. Zambere ntago nize.
So do you mean 4 classes including the first one?
Gatera Fred. Aya mazina pa nani raji. Jamin Niziera Niziera
Another one.
Jamin, is it Jamin? Germain, yeah.
Or Jerome,
is there? Gloria Nadine Mugwaneza.
She has been on the online.
Was here.
Was he there?
Yeah.
Yes.
Hakim. Very Nwari. Hakim. Igabe Erachiza. Igabe. I think I saw her yesterday. Innocent Nzeyimana. Innocent.
Present.
Present. How many class?
Two class. Two class.
Za nyuma. Bigirimana Jacques.
Present.
How many class?
Classes.
2.
2.
Ese za mbere mwari muri he? Mwami is many things. Jenny Muberanyana. Jen. Janet, I think Janet, I've seen you. Janet, how many class?
Classes.
2.
4.
Yose za mbere mwari muri he?
I have attended
Jan Bosco.
I have attended 4 classes.
You have
4
attended
classes.
4 classes. The first to first.
Janet is saying 4. 4.
Okay. Jan Bosco Munyangabe. Jan Bosco. Jan Claude Maniraguha.
Yes, sir.
How many classes?
4 class. 4. Yes.
Habimana Jean Dadieu. Habimana? Rudachogora Jean Dadieu.
Yes.
How many?
Present.
How many class?
4 class. 4.
Jeanne-Marie Viviane. Nakirutimana. Mugabo John. Mugabo John. Aline. Jambere, ziri yambere. Jambere, I don't know. Aline yambere, Jambere. Kanamugire James. James?
I'm here, sir.
How many classes Kanamugire?
Unless it's second one. I have 3 classes.
3?
Yes.
Okay. Then you have Karehe Marijen. Karehe. Leia Omuhoza. Leia?
Present, sir.
How many?
4.
4.
Yes.
Martin Kavera. Martin.
Yes, sir.
How many?
4 times. Yes.
Mbaba Ziskovia. Mbaba Ziskovia.
Unpleasant.
How many classes in Babas?
4.
Then Meditias. Mukamsoni. Present. The good thing I apologize the way to pronounce. Ndorimana Denise. Ndorimana. Nelson Mutangana. Nelson.
Classes. Yes. 4 classes.
Some code Jenny is typing that it is pleasant. Jen.
The internet is very disturbing.
Jen said is pleasant.
Shimimana Marcel. Marcel. Olivier Saviman. Saviman Olivier. Patrick Kabanda.
Yes, sir.
How many?
Sir.
Eh?
Excuse me, sir.
Yes.
Hello.
Hello.
Olivier is there.
How
with
many
3
classes?
classes?
4.
3 classes.
Kabanda?
I'm allowed, sir.
How many?
4 times.
Paulo Kaisire. Paulo?
I attended the 4 classes.
Kaites Peace. Kaites
I attended 4 classes.
Kaites Peace. Kaites Peace.
I attended the 4.
Providence Uwiraji. Epimak Utare Uterana. How many?
2 classes.
2 classes. Rakai Gamba Patrick. Patrick Rakai Gamba. Safari Charles. I think I've been seeing this one. I've also been seeing in Kush.
Kus there.
Theogene, Osingim. Theogene. Venuste. Ives.
Class for today and yesterday, Wednesday.
Venuste, how many? 2.
2 today and yesterday.
Then Mufanzara Ives. Warangi.
There's some names of which I've not mentioned.
Yes?
Yes, I think you are using the old list.
Some names are nowhere to be seen.
You are using the old list, please. There is a new one list.
There is a new list.
Some
Yes.
of us have not
New
had
people
names.
joined the song. Like me.
No?
New people joined.
Hello?
Excuse me.
Hello?
Yes.
I'm saying some of us have been there from the start, but we have not had our names being mentioned there. I don't know what's going wrong.
Gukoresha liste itariyo.
Uri gukoresha liste itariyo.
None se ni bangahe
urakoresha wene hari abantu batariho
hari liste bata
niyo bansendingiye ejo bundi yingi.
Abantu baje kwiga UK.
No?
Yes.
Of us have been there from the start, and I don't know why our names are not being mentioned. So you better really check it.
Okay.
Lecturer, did you call me?
You are called who?
Eve.
Even akwamagaye.
Yego, amuhiya narinje gatoya hanze.
Umaze
Amaseni Harerimana.
Excuse me.
Omamagaye Yvonne Uwizeyimana.
Eh?
Yvonne Uwizeyimana.
Yvonne Uwizeyimana.
Can I put a V on my name?
Yes.
Yvonne Uwizeyimana 4 times.
Yvonne se na orimo se.
Me too.
Mwandika amazina muri chat room nyarebe.
We have done so.
Yeah.
Uwizeyimana Yvonne. Unari copies. Now, what about your email? How will I know the email? Undi ndi kubona ni Harerimana Jean Damascene.
Niyonzima dos Santos.
Yes.
Dos Santos Niyonzima.
Niyonzima ntabwo wari urimo pe. None email zanyu senda zibona gute nimba ndi kusendinga zitarimo?
Urazifite ujinyoherereza.
None se ko tari kuri list
David Nkuriki Mutabazi. David.
Erambo na Angelique ariko nari.
David Mutabazi.
Yes. Ngororano Damascene sinarisomye. Nkusi nari namusomye.
Ntabwo wansomye igihe ariko
maybe narisomye nabi.
Oya.
Chala. Hello?
Yes.
Hello?
David Nkuriki Mutabazi ntabwo wasomye. David Nkuriki Mutabazi.
Bazendigiye hano se? Babazi Scovia, sinambona Babazi nayisomye.
Hello?
Yes.
Sorry, sir.
Yes.
Yeah. My name is Sifura.
It is Fura.
Yeah.
Furana alisomye.
Yecha David. Hello?
Yes.
David ntabwo wasomye David Nkuriki Mutabazi. David Nkuriki Mutabazi.
David namusomye.
For class.
Yes, kwana limaze. Sibarangiye se?
Iyamuremye.
Iyamuremye?
Hari umutavuganye.
Excuse me, sir.
Yes.
Karemera.
Urana yarisomye izina ryawe.
Karemera.
It is 2 classes.
2 classes.
Yeah.
Okay.
Yes, sir.
Yes.
I have attended all class.
Who is this one?
Ive Mufanzara.
Ive?
Mufanzara.
Narisomye.
Amazina amaklase yose.
Okay.
What about Sunday?
Sunday ko nari. Sunday wariyanditse.
I sent my name and email.
Birimo hano?
This is my second class.
Sunday?
Yes, please.
Yes, please.
The chat
Ko nari kuribona wariyanditse he?
in the chat
Karemera naryanditse.
Yes, please.
Karemera.
Hello?
Yes.
Hello. Hello.
Yes. I think we have finished.
Hello?
Yes, please.
Okay, now let me copy. You are police now go.
Excuse me, sir.
Yes.
I'm Aline Jambere. I'm attending today.
Oh, Aline Narisom.
Aline Jambere.
Hello.
Yes.
Hello.
Yes, please.
Yeah, Iyamuremye Aime classes.
Hello.
Yes.
Providence, Umiratie, 2 classes.
How many class Providence?
2 classes.
2 classes, okay. Okay, so we shall discuss again. Okay, thank you very much.
Excuse me.
Yes.